Hey everyone, welcome back to Corporate Decoder, the place where we uncover the juicy secrets hidden in plain sight. And today we're diving into AfterNext acquisition, iCorp's S-1 filing. Let's just say when it comes to blank check companies, this one has more layers than a diplomatic onion. So what is this all about? Imagine a company that is basically a financial shell, ready to go public and then find a business to buy. That is AfterNext acquisition iCorp. They're trying to raise a cool $100 million, but here is the kicker. They haven't even picked a business to buy yet. Think of it like buying a house and then deciding you want a Tuscan villa. But you are currently looking at blueprints for a suburban ranch. This S-1 filing is their big reveal, laying out all the potential upsides and, more importantly, the sky-high risks. Let's jump straight into the numbers because that is where the real story often is. As of the 29th of August 2025, their total assets were a measly $85,900. Now, that might sound tiny, but remember, this is a company that is just getting off the ground. Pre-business combination. The real important number here is the value of ordinary shares subject to possible redemption, which is a massive $100 million. This is basically the money they've raised from you, the investors that they're promising to give back if they don't find a suitable business to buy. It shows how heavily this whole venture relies on finding that perfect match. They're offering these units at $10 a pop. Now let's talk about dilution. This is a fancy word for when your ownership share gets smaller because the company issues more stock. And boy, are these guys talking about dilution. They're saying that as of the 29th of August 2025, after all the fancy calculations, the net tangible book value per share, which is basically what each share is worth in terms of tangible assets, hovers around a low number, ranging from just $0.20 to $0.21 if the underwriters exercise their full over allotment option. That means if you buy at $10, you are looking at a potential immediate drop in value. It is like buying a brand new car and realizing it lost a good chunk of its value the second you drove it off the lot. That 98% dilution figure is a stark reminder that the early investors, like the sponsor, bought in at practically nothing, while you are paying a premium from day one. Now, who is behind this venture? We have AfterNext sponsor ILC, of course, but what is really interesting is how much these initial investors are getting for so little. They bought 383,333 founder shares for a grand total of $25,000. That is about $0.007 per share. Then there is the private placement of 350,000 units at $10 each. Totaling $3.5 million, their stakes are significant, and that low entry price for the founder shares could mean a massive payday for them, even if the company doesn't perform spectacularly post-combination. It is a classic SPAC structure where insiders have a strong incentive to get a deal done, any deal, to cash in on their early investment. Now, this is a really interesting section. While they say they won't do a business combination with entities based in mainland China, Hong Kong, or Macau, their sponsor and key management are based in Hong Kong. This creates a whole web of potential risks. They might be subject to Chinese laws and regulations, and the Chinese government could intervene in their operations. Imagine trying to buy a house, but the seller lives in a country whose government can suddenly change the rules about foreign ownership. It adds a layer of complexity and uncertainty that is hard to ignore. This also means that finding a target business might be harder because some might shy away from a SPAC with these ties. Diving into the risks associated with their own securities, we see a few red flags. They've got this thing called rights attached to the units. Think of them like little bonus tickets that could turn into shares later. But if the company doesn't find a business to buy, these rights expire worthless. That is a big risk for investors who might be counting on those bonus shares. Also, the low price paid for founder shares means immediate and substantial dilution for new investors, as we saw in the financials. It is a tough pill to swallow when you realize your investment might be worth a fraction of its purchase price from the get-go, just because early backers got in for pennies. This is where things get really spicy. Their officers and directors might have obligations to other companies, meaning they might have to offer business opportunities to others before considering AfterNext. Add to that the fact that they will own a significant chunk of the company after this offering, and you've got a recipe for potential conflicts. They might be more inclined to push for a deal that benefits them personally, even if it is not the absolute best for all shareholders. It's like having a real estate agent who also owns a piece of the house they're selling. Their personal stake could influence their advice. So what is the game plan? They're aiming for fintech or technology-enabled financial service companies in the Asia-Pacific region, excluding China, Hong Kong, and Macau. They specifically mention digital payments, insurtech, decentralized finance, alternative credit, wealth tech, and blockchain. They see big growth potential driven by rising incomes, tech advancements, and digitalization. That sounds promising on the surface, but remember, they haven't found a specific target yet. It is like saying you want to go on an adventure in a specific continent, but you haven't booked a flight or picked a destination. Let's look at the team. They boast extensive experience in finance, capital markets, and SPAC structuring. Jiyoung Anna Zhou, the CEO, has been with several Nasdaq-listed SPACs. Shushun Susan Tao, the CFO, has a strong finance background in Hong Kong-listed companies. Ki-hung Eric Wong, the chairman, has legal and capital markets expertise. Then there are several independent director nominees with diverse backgrounds. While they project a competent image, it is crucial to remember their affiliations. As mentioned, many have ties to Hong Kong and other entities which, as we've discussed, can introduce conflicts. It is a solid team on paper, but the real test will be how they navigate these potential conflicts and deliver on their promises. Diving into the financials here, it is pretty sparse as expected for a pre-revenue company. The balance sheet as of the 29th of August 2025 shows minimal assets and a significant working capital deficit before the offering. After adjusting for the proposed offering, they have a substantial amount of shareholders' equity, but a huge chunk of that $100 million is from shares subject to redemption. This highlights that most of the money raised is essentially on hold. The net loss from operations is also very small, just under $15,000, which is typical for a company in its formation stage. My take on AfterNext acquisition Corp is that it's a high-risk, high-reward play. Typical of SPACs, the team has experience, and their target market in Asian fintech sounds potentially lucrative. However, the significant dilution for new investors, the potential conflicts of interest stemming from their Hong Kong ties and existing affiliations, and the fact that they haven't even picked a target business yet are major red flags. The structure, especially the low entry cost for founders, means they have a strong incentive to complete a deal. Any deal, which might not always be in the best interest of public shareholders. You're essentially betting on their ability to find a gem and then execute a successful merger, all within a tight deadline and while navigating complex international regulations. It is a gamble, and like any gamble, you should only put in what you are comfortable losing. Alright, that is our breakdown of AfterNext acquisition, Corp's S-1 filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into the corporate world. Oh, and don't forget to check out our Discord community, linked in the description, where we talk more about these filings and other insider insights. Thanks for watching, and see you next time on Corporate Decoder.